Hi everybody, this is Seth Martin with the Middle Class Investor. Today is Saturday, July 19th, and let's see, we're coming off a pretty, we had a big sell-off and then kind of a bounce back. Both were strong. We had a strong down and a strong up, so kind of really a whole lot of nothing happened. What I've got on the page is our rising wedge. For those of you that don't know, we've been talking about this rising wedge for a while. The rising wedge is it's a technical analysis term, and it refers to this pattern you see here, which is a narrowing pattern where prices over time tend to narrow as the market gently trends upward. And as you can see, this blue line here, the mean, price travels away from the mean and then pulls back to the mean, and then travels to the mean, pulls back to the trend line, so on and so forth. The thing about a rising wedge, the amount of money, that investors can make trading this pattern, they're all trading this pattern, okay? And then what happens is it narrows so much, it tends to give way to some sort of either breakout or breakdown. Now, the rising wedge, there's also something called a bearish wedge or a falling wedge. Let me see if I can kind of draw one real quick. A falling wedge looks like this, right? Where you've got prices are kind of bouncing here and there, and this is a falling wedge. And the falling wedge is actually a bullish pattern. It tends to continue to do this until it breaks out, and then it breaks out to the upside. Now, these patterns, they're about, it's about, I think the rule of thumb is it's about a 60%, they're about 90, if they break out of the pattern, if you break out to the downside, and it looks like here we broke out, but it didn't confirm or whatever, it wasn't a clean breakout. But if you break out to the downside, they're like 93% effective. And what does that mean? Effective only means that you come down here to the beginning of the pattern and you measure the distance between this red line and this red line, and you add that to the breakout. So that's what we've been watching. That is a technical analysis phenomenon. For those of you that aren't familiar with technical analysis, there's certain tenets in technical analysis. One of the tenets is the trend. If the trend is in a particular direction, it continues. The probability is that trend continues. Another tenet in technical analysis is support and resistance. So we haven't talked about that much, but we've talked about it a little bit, but not a whole lot. Support and resistance, basically one of the ways you could look at support and resistance is there's a couple different ways people do it. A lot of times people will go to the most extreme point, that being an extreme point, this being an extreme point as an example. And before all this happened, this would be resistance and this would be support. And then obviously as the market pulls down to a swing, so I don't know if you can see that or not, but there's swings in here. There's a swing here, and then there's a swing, and then, I guess, there's a little bit of, you can kind of see a swing here. There's a little bit of subjectiveness in technical analysis. And the subjectiveness has to do with the time frame you're dealing with and also what you see. And as the saying goes, you can only trade what you see. So if you can't see it, it's not something you're going to be able to trade anyway. So, and that kind of leads me to, why we're here in the first place, right? We're here because a lot of people, when they have their investments in 401ks and IRAs, they kind of fall prey to the psychology that comes into trading or investing. And the psychology kind of goes like, let's just put in a 6-month chart and let's look at it. Let's say that the market sells off really hard. Maybe down in here to this 1850 area, okay? And then, what happens is mentally in your mind you say, "Oh my gosh, man, I probably should have sold," and you didn't. So you say, "Well, I'm gonna stay in." So let's just draw this real quick while I'm talking. I'll kind of draw in the psychology. So, the market. Let me zoom in a little bit here. Let me get some space here. Okay, so the market begins to sell off, okay? Something like this. Maybe it sells off past this support area, okay? And you say to yourself, about this point right in here, you say, "Oh my gosh, maybe I should have gone to the sidelines or something," okay? And so, but you didn't, so then you say, okay, well, maybe it'll come back, So, and that's in fact what it does. It comes back up really hard, and you're thinking, "Oh my gosh, I'm a genius, I didn't get out." So it comes back up really hard, and then you kind of go back to sleep. You don't recognize this blue box here is a key support area, and closing below this key support area basically means this is no longer support, okay? So then, about the time you've been lulled back to sleep, you get one of these numbers where it just goes way down, maybe into that 1700 area. And then you tell yourself, "Well, I can't do anything now, I'll have to wait," and it goes down 15%, and then you tell yourself you got to wait, it's going to come back, and it goes down another 20%, and so on and so forth. So part of the strategy behind what I'm trying to accomplish here is to put some of these support areas in and these resistance areas so that we can call attention to them if they're broken. Because if they're broken, that tells us that there's a potential, hear me carefully here, a potential trend change. So what constitutes a trend change? Well, let's go back to our drawing. Let's say the market did one of these deals and it sold off, okay? And let's say it sold off to right into this area. And then it bounced back and it starts climbing. Now, anything short of a new high would be a potential trend change. So if the market turned right here and went down and actually made a new low below this low, okay, we would say that's likely a trend change, okay? And this is what you want to watch out for in your 401k or IRA. This kind of up and down here is not really all that important. It's just price fluctuation. And over the time frame that you invest in a 401k or an IRA, that's acceptable price fluctuation. And so you don't really want to be taking action there. But what you want to do, the first thing you want to do is you want to look for a break of support. Now we're calling this blue box here support. So if the blue box was broken, that would be red flag number 1, okay? Red flag number 2 would be if you came up here and actually made a lower high, okay? So we got a lower low, so come back to a swing, it's lower than this low. So it would be lower than this low, it would be lower than this low, and it would even be lower than this low. Now, this box, drawing this blue box, that's where the subjectiveness comes in. Basically, what you want to do when you kind of look at where to put these boxes, you want to look for what we call important swing. So, if I zoom out, what's an important swing? Well, I would say this one right here is important because it came up strong here, made a new high, and pulled back, and then resumed. Okay, so I would say this swing right here is probably the most important recent swing on the chart. And you can see that is the June 12th low. Okay, so I would say the June 12th low is pretty darn important. Now, beyond that, you come back here. The next most important swing is this May 15th swing. So these are the ones we want to key on. So if the market pulls back, let's do a couple different scenarios. Let's say the market just pulls back like this. To say right there. Okay? Well, it's lower than this high. Okay? It's lower than this one. But it's not lower than this high. Yeah, I didn't draw it on there right, but and so what we want to do is we want to see it move up from here, okay? And if it moves up, then we can say the trend is still intact. It might move up something like that, okay? Something along those lines. Now, if it actually comes down, let me see if I can draw onto the end of this, okay? And it breaks through this box, and then when it comes back up, let's say it gets to about there and then turns down, okay? Well, now we could say red flag number one, we have broken through our box, okay, our blue box, and we've closed below it. Now, it is true that it came back above it and actually pretty strong. But then, red flag number two, it made a lower high. This high now is lower than these highs over here. You can see that. If I draw a line across here, you can see that these highs over here, these two highs here, are now higher than this high. So now we've got a potential trend change. Now, when can we say the trend is actually changed? Well, you say that once you break this low. Now, you could actually make a decision right here. Once it did this, and you say you got 2 days in a row of down, you could say, okay, I'm getting out. Okay, I'm going to go ahead and take my profits, and I'm going to sit on the sidelines. That's perfectly okay. But just keep in mind that you're really not in a trend change until you break below this new low here. So as you can see, that's quite a bit of risk, right? You're giving up about 100 points on the S&P 500, which is not insignificant. But that's how you would do it. Now, there are ways to make decisions earlier, but the reality is, in a 401k, it's not real practical to do things on a shorter time scale. I mean, you could go over here, we could pull up a 60-minute chart, okay? So now each one of these is an hour, and we could look for, a swing, okay? So let's say this swing here is important. Let's put a box there. So now this swing is important, we're saying, okay? And if the market sold off, well, I don't have a lot of room to work with here. It's not looking like, but let's say the market sold off something like this. Oops. Okay, and it broke this what we've already identified as support, and then it went back up and made a lower high. We could make a decision on this time frame. The problem is, in a 401k, it's just not practical to do, so we don't typically do that. Let's go back to a daily chart. Actually, let's go to a weekly chart. So there's our rising wedge on the S&P 500. If you look at the interest rate, we talked about this last week. We got this identified down here as an important low. So let me see if I can. Okay, let's do that. So I've got this down here identified as an important low, kind of like like what we did earlier. Okay, and then I'm saying what I'm presuming, and it's a little bit of a I'm taking I guess a little risk here in saying that this is the low and this looks like the first move off the low. So what I'm looking for to happen is a pullback, just like what we got here. So we got it. You can kind of see this little down, up, down. Okay. Now, a lot of times it'll stop right there and then continue higher. But if this is the important low and this is the first move off the low and this is the pullback, this next move is going to be very, very strong. Now, it's possible that this is not through pulling back. So you could see something like, you get this little jog up like we have here, and then we get another strong pullback. And this will be pretty strong because there's really no support until you get down to this box. So it could be something like this, and then stop here. And then this move will be very, very strong. If, in fact, this is the low, and this is the first move off the low, and this is the pullback off the first move off the low, this next move up will be very, very strong. So the reason we've been talking about this is because this is if you're in bond mutual funds in your 401k, and as long as the market is moving in this direction, the interest rate market, you're making money in your bond 401k. But when it starts moving in this direction, this upward direction, you're losing money in your 401k and in your bond fund. So that's why we wanted to bring that up. It's just something to be aware of. You need to watch this bond market very, very closely. The 10-year Treasury note is basically it's also known as the risk-free Treasury or the risk-free rate. It's what bondholders are willing to loan the U.S. government for its various expenditures that it does for Social Security, Medicare, all the programs we run in the federal government. So that's what that is, and the idea is that if you get a sell-off in the stock market, you might have people run to this market out of safety, out of fear, a place to park their money. Because one of the things I can't remember if we talked about it or not, but one of the advantages you have as someone who kind of keeps an eye on their own money is if you give your money to a mutual fund company, they have to be 95% invested in something. Okay, that means if they sell stocks, they got to go into bonds, they got to go into something. Okay, real estate investment trust, something like that. One of the advantages you have as an individual investor is you can go to cash. So now I realize most of you aren't doing that in your 401ks, but you might want to consider doing it if we have a really hard move up in the bond market, in the interest rate market, and or if we have a really hard move down in the stock market, and we'll help you identify that. The Dow looks pretty similar to the S&P 500, although it looks a little stronger. It looks like a little bit more money is flowing into the Dow than into the S&P 500. Here's the euro. So there's a relationship between the dollar and the euro, and this is it right here. This is as this goes down, the dollar is going up. So our next level of support is right here with this blue box. But to me, it looks like the euro is on its way to making lower lows. So if you look here, the euro came down, it found support, it moved off support, it pulled back. Now this is different because if you go back and look at this is a much different situation than the bond market. Let's look at, like, I don't know if we can go 10 years. I don't know how the old euro is, but this was the low here, and it pulled off. And the euro I suppose could go higher, but I suspect what's going to happen is the euro is going to sell off, and the euro and the dollar might actually get to what's called parity. So right now it takes $1.352 to buy 1 euro. but parity would be like $1 for €1. So that means the euro would have to come down pretty significantly down here to $1. The NASDAQ looks a little weaker. It didn't make a new high in that most recent run, or it did actually, but then it pulled off harder. The other one that looks pretty tough is the Russell 2000. Let me pull that up real quick. It looks weaker. You can see here last week it sold off harder. It came back, but not quite as far back as the S&P 500. And then the other thing we looked at a while back is the volatility index. Excuse me, dollar VIX. This is as this goes up, what that means is that traders are willing to spend more money to buy downside protection on the market. So you can see we had a real spike up in volatility here, and then of course it came right back down. Volatility is very volatile, no pun intended, but you can see it kind of made a move, and then it made a move up, and then it pulled back. Volatility, a lot of times after it makes a big move like this, it'll chop around a little bit and then make another move in one direction or the other. A lot of times what we look for on the volatility index, if you notice here, it's negative 17%, but if you look at the S&P 500, you'll see the S&P 500 is up. So a lot of times what you'll do, you should see, if the market is up, you should see volatility down and vice versa. So a lot of times, I look at the S&P 500 and then I'll just go see if the volatility index confirmed. So a positive confirmation in this particular case would be the market was up, it's in the green here, but the volatility index was down. Well, that's a normal correlation. Sometimes you get a correlation where the market's up and volatility's up, or the market's down and volatility's down. And sometimes you need to go to another market and look at it or something like that to get a better picture of what's going on. So anyway, that's about it for today, guys. I don't want to go much further than this. I don't want to put people to sleep. You can find these videos at Middle Class Investor on YouTube. You can follow me on Twitter at InvestorClass. The links you can copy and email to friends and family. Spread this around. Let people know what we're trying to do. We're coming up onto a time that's going to be, this information is going to be really helpful, and which is one of the reasons I started doing this, is I wanted to make sure that people, weren't asking the wrong people about what to do, and I wanted to put out videos early enough so people could learn a little bit too while we're doing this. If you have any questions, you can email me. You can comment on the email is just middleclassinvestor@gmail.com, and you can also comment on the YouTube videos, and we can dialogue back and forth, and that way everybody can see what's being said. So anyway, that's it for today. I'm going to go ahead and shut it down, and if everything goes well, we'll see you next week, and you guys take care and good luck. Have a great summer, what's left of it. Take care, everybody.